There it is. All right, and good morning. We're live. It's Friday, September 6th, 2019. And I keep mentioning this because I'm still blown away by it, but my grocery store already has Halloween candy on the shelves.
Isn't that amazing? Wait a minute. Stop. It's too soon.
Is it still going to be good by Halloween if I buy it now?
Yeah.
Well, the question is, will it last until Halloween?
Well, and you know it won't, which is why I haven't bought it yet. It's crazy. I guess there's really not much going on between now and Halloween, though, holiday-wise, right? So I guess they just get ahead. And it probably is smart for that very reason. They probably know if you buy it now, you're going to eat it and you're going to need to buy more.
Mm-hmm.
So you have Christmas decorations by Halloween, right?
Well, yeah, they usually the minute Halloween's over, then you start with Thanksgiving, right?
And boom, you're right into Christmas. They're going to start combining those holidays here, Thanksgiving and Christmas. They almost do now anyway.
Yep. All right. Good morning to Sarah Laidlaw, Katrina Way, Tiffany Stewart joining us on the Facebook feed from Canada. Diane Muller or Mueller. I never feel like I know how to pronounce that properly. Also from Canada. Jen Castro, who I believe tunes in from, if I'm not mistaken, Mexico. Either that or she has it's either that or it's a client. I don't know. Jen, feel free to comment and tell us where you are. Anyway, hopefully those affected by the hurricane are not too badly affected by the hurricane. I know my parents got lucky there in Delray Beach, Florida, kind of past them. But then I know it hit people living in Virginia and nearby there. So hope everyone is okay. All right, so we're starting a kind of a series today that I had laid out. And we've been talking a lot in 97 and up about business valuation and cash flow. So I wanted to talk about that here and kind of go through a series of stuff on it. So today we're just going to talk about something I think most of us here are pretty familiar with how to do it. But as you know, I have my own sort of way of looking at these things. So we're going to look at, credit memos and refunds, but a detailed look at, the impact on cash flow and what affects cash flow, what doesn't, those kinds of things. So we'll take a look at that in a minute. Couple of housekeeping things. I started working today on something new. I'm going to share my screen in a second and show you all. The Bulletproof Bookkeeping course is very, very close to completion. I'm going to show you exactly how close. And what I'm doing is I'm going to catalog all the courses in Airtable, which I love because it can be embedded on a web page, so I can make it really easy to see. I hadn't realized how much content I had actually produced on this course until I started putting this together this morning. But as of right now, there are 60 lessons in total, so, and this is what's left. The ones that say writing and recording are planned. That's basically it. This is like a week or two's worth of production for me. There's a couple other things I went back in and said I want to stick some things in. So we're going to do that. And this catalog is going to have the URL that links directly to each lesson, which of course you won't be able to access unless you're signed up. And I'm going to go through each lesson and show you the video duration here, just so you have an idea of how long a lesson is. So I should have this sort of fleshed out by the end of the weekend. And then the beautiful thing about having this in Airtable, even where it's embedded in a page, is then you can take something like this group function and you can say, let's group it by section title, right? And then it just quickly breaks it down. So you have everything on banking and bank feeds, bulletproof loans. It's going to put it in alphabetical order when you do that. And that may actually be useful rather than just seeing it in the order, of my outline per se. Anyway, I love doing stuff like this. I love getting things organized like this. So that's pretty close to being finished, but lots and lots of content already available in the course. And then the other thing I'm going to be doing this weekend is producing some videos aimed at promoting the course and encouraging people to sign up, of course. And then I'll probably be running some Facebook ads to help things along the way. So that's where that's at. And then the very next course to go out there is going to be property management with QuickBooks Online. And most of that's already been recorded. So that should get rolled out pretty quickly. Some of you may have noticed some intermittent downtime on the site. You'll go to the page at new.nerdenterprises.com. It'll tell you the site is not secure. That is because I had to move name servers around and do some things in the background, and also had to reinstall the security certificate. So it should be fully functional, but if you do happen to go onto the site and get a message that says the site's not secure, just rest assured it's resolving. And sometimes these things kind of bounce around in the background before they're completely up and live. But it should be, for the most part, working. I thought it was completely resolved by this morning, but then I noticed for a little while it was giving that message again. So everything should be good to go there. But of course, if you run into any trouble, just reach out to me and let me know. So let's talk about how cash flows. Let's talk about refunds. We're going to talk about it in QuickBooks Online. Looks like I got signed out here. Let's get rid of this stuff. I'll put that back over on my other screen. All right, and I'll do my best to check in on the Facebook feed to make sure that if you have any questions or comments there, I will follow up on them. Alexa Gregory is also watching from Facebook, and Jen confirmed that she is, in fact, in Mexico. I thought so. Let's do this. Let me get logged back in. I'm going to stop my screen sharing while I log into QuickBooks Online real quick. And I guess account text is still going on today, right? Is it?
I'm not sure. I thought today would be like the last day.
Yeah, maybe today, or maybe it was over as of yesterday, and today everybody's coming home from it.
I thought today was day 2.
Oh, is that? I have no idea. I've never gone. After this leader conference was done, I stopped going.
I registered and got emails, but I didn't go.
Yeah. Is it free for attendees?
No, but you could register and then just get information.
I see.
And you get on mailing lists and such.
Got it. Okay. Well, I hope those who went had fun. I stayed here, produced videos. And I had fun. So I'm not even going to QuickBooks Connect this year because I just can't leave my wife and my home for too long right now, just with everything that we have going on. So I am going to be staying close to home for the foreseeable future. All right, let's get back to sharing my screen. Let me just get into one of my sample companies here. Sarah says, I just saw a live feed from Linda, so I guess they're still doing stuff there. All right, so by the way, I just this week produced a video on intercompany loans. And I thought it was pretty cute the way I laid it out. I'll show you what this looks like real quick because it's all QuickBooks Online, same kind of stuff, how to do it sort of bulletproof. Let's go here. Let's go here real quick. I want to show you this to give you context for why I have a sample company called On Target Inc. Let's go to my course locker. And Buzz. So Nerd Buzz, in case you don't know, is sort of the new blog. It's free, but you do have to check out as though you were signing up for a course, but it's a free course. It takes 2 seconds, and then you have access to all the prior Zooms here. And QuickBooks Online is the category where I've been publishing a lot lately. And here's record intercompany loans in QuickBooks Online. So this one I had a bit of fun with. And so we have a client named John Wick. He's a professional hitman, and he's got 2 businesses. One is called For Hire Inc., and the other one is called On Target Inc. And he has to buy some ammunition, and he uses a credit card for one of those companies to buy all the ammunition, it has to be split between the two companies. So in the video, I, of course, walk you through, and you can see I have detailed write-ups on everything in NerdBuzz that kind of walks you through, you know, how to do all this in QuickBooks Online. So I'm having a bit of fun over here on NerdBuzz. So if you haven't already signed up for it, sign up for it. Like I said, it's free. It takes a second. You literally just enter your email and check out and decide if you want to get my weekly emails on Saturday by checking a checkbox off if you do. So anyway, that's why I've got a sample company here called On Target Inc. And I've also prepared my famous T account template for today's sort of lesson that we're going to look at and walk through. And if if you got used to posting refunds and dealing with refunds and credit memos and those sorts of things in QuickBooks Desktop, it works a little bit differently in QuickBooks Online. I remember when I first started playing with it, I was like, whoa, and then I got the idea of it, and it started to make sense. So I want to kind of just walk through a series of transactions. And of course, in my usual style, we're going to post things, and we're going to look at how it affects the balance sheet and the profit and loss, and, heaven forbid, the statement of cash flows. So first thing I always like to do here is I love to run the trial balance report for all dates, especially in a sample company, to make sure I've properly cleared it out, make sure there's nothing there. And for your sake, I want you to see there's no tricks up my sleeve. This is, in fact, a clean company file with no data in it, right? So the first thing I want to do real quick is this first transaction. We want to set this company up with $500,000 initial deposit into the bank in the form of an owner contribution, right? So let's do that real quick. I'm just going to create a bank deposit. We're going to go back to the first of this year with it. All right, Continental Bank. Remember, John Wick goes into the Continental Hotel. And I am going to put this to opening balance equity. Funny story about this one. So a few weeks ago, maybe like a month ago, I had posted a screenshot of a balance sheet from one of the lessons from Bulletproof Bookkeeping on Twitter, and I was making a comment about, I forget what it was about specifically, but I had a couple of CPAs on Twitter who replied to it, remarking that the balance sheet didn't balance, which I thought was interesting. It was only the first of 2 pages, so there's no way you could have known whether or not it balanced. So it was just ironic to me that CPAs were commenting on the balance sheet not balancing, and we're supposed to be known for attention to detail, and they missed an important detail in making those remarks. And then another one commented that, there's no way it's bulletproof if it's got opening balance equity in it. And once again, I'm like, that comment scares me from a CPA, because it's like, no, there's definitely a good reason for having opening balance equity, such as when I'm setting up a new balance in a new account on an existing set of books. It's perfectly appropriate to have opening balance equity there, right? The only other way to do it would be like in a case like what we're describing here, is if we actually call it shareholder contributions, if in fact it's money being deposited at this time from the owner and being contributed into the business, right? So I think if I had a Y in the date, it takes me back to the first of the year, right? So I often forget to use some of those little date keyboard shortcuts, but there it is, the letter Y. T, of course, goes to today. Y goes to the first of the current year. All right, so we're just going to quickly, and of course, T account-wise, what are we doing in transaction 1? Right, I'm debiting the bank account with $500,000. Okay, and then in transaction 2, we'll just use owner's equity for this, and we'll call it a credit of $500,000, right? Trial balance balances, transaction 1, ready to post, save and close. All right, let's duplicate, and let's duplicate again. I'll go over here, we're going to run the balance sheet. Okay, there's my $500,000 in the bank and $500,000 in equity. Of course, in a transaction like that, all the actions on the balance sheet, nothing happening on the P&L yet.
Seth, I want to tell you, I love how you're using forms to make journal entries.
Forms to make journal entries? What do you mean?
Right, you're using the deposit form to make the first journal entry.
Right, well, in this context, though,
Sorry.
I'll get it. Is that for me? Well, what I was also sort of saying there was that in this case, I'm assuming the example is one where we are actually depositing money into the bank to open up the bank account with $500,000. But yeah, thank you. And I do use journal entries sometimes. I think there's a time and place for everything, right? I do use journal entries. In fact, in that post I just showed you with John Wick, in the company that did not pay for the ammunition, I did use a journal entry to debit that company's inventory and credit the due to from the other company to demonstrate the intercompany loans. There are times I think a journal entry really is the best way to record something.
But if you use forms, you get, I feel, better reports.
I know. I see that a lot, and I agree. Certainly, if we are, and I made this point in the video, that in the interest of time, I was using a journal entry and debiting the inventory asset, and I made it very clear. Normally, I would not do it that way. You would have to use a bill or a check or something to zero out so you can access the items portion of that transaction and itemize the inventory properly, right? So, yeah, there's definitely advantages for sure to using a $0 transaction as a journal entry instead of doing an actual journal entry. No question.
You get half the entry rate when you use forms.
Right. All right. Oops, I hit the wrong thing. Let's go to the statement of cash flows and look at that. Now remember, I showed you the trial balance. There was nothing on there. So all that's happening here is we have zero net income, right? We haven't shown any net income. All we've done, so we're starting with cash of zero. We've added a contribution, which goes in the financing activities, of $500,000. And that's going to be our cash at the end of the period, which of course agrees back to what's on the balance sheet in the bank account, right? So next, we're going to record an invoice. Let's make it for 100,000. Okay, so we're going to invoice a customer for something. Doesn't matter what. The point of this is just to understand how the cash flows. I don't really care what we're selling, who we're selling it to, or how we're selling it, right? So let's go ahead and go to the P&L, since this is the first thing that's going to hit the P&L, and I'll just kind of do it off this screen, and we'll create an invoice. And for those of you wondering when I'm going to get to refunds and credit memos, before we can do that, we have to have an invoice before we can issue any kind of a refund. In fact, before we can issue a refund, we have to have a payment. But that's where I want to get clear on the distinction, because whether or not we've been paid has a significant impact on how we approach this. And I'll explain what I mean. All right, so who are we going to invoice? Usually I have a customer called Always Right or something like that, because I'm just funny that way.
Brad Smith.
I was doing one on real estate, and I had him as one of my tenants. 2700 Coast Avenue is actually one of the addresses of Intuit in Mountain View. Oh, good. Sales calls are coming in. I love sales calls. Okay. Anyway, let's just create one real quick. All right, so I've got a customer here called Always Right. All right, let's just say this happened on January 5th.
How'd you know it was a sales call?
Because my home number, nobody has except for my mother, and she never calls me on that line anyway. She calls my cell phone. So that when that line rings, it is always a sales call. And I love answering the phone, and when they start off by saying, it's not a sales call. And I say, yes, it is. And eventually, even though they swear it's not, we'll get to the bottom of what they're selling, and then I'll call them out on it, and then I'll hang up on them. Okay, so we're invoicing somebody for $100,000. And I really believe that going through the debits and credits and the T accounts really helps understand the flow, right? So in transaction 2, oops, didn't mean to do that, we're invoicing a customer. So no impact on the bank account, right? We're not collecting anything. We're just invoicing. We're acknowledging that we are now owed $100,000. I forgot to count my zeros. That's right. And so the debit, of course, goes to accounts receivable to increase the asset, and we need some kind of an income account here, which we'll just generically use this one in transaction 2 to credit the income that we've now earned of $100,000, right? And this kind of goes to one of the points I often like to make, that even though a lot of us might be cash basis taxpayers, we're still always accrual basis businesses, right? To try and run a business purely on a cash basis would be to ignore this transaction entirely. And I wouldn't know that I had a sale, and I wouldn't know that somebody owed me $100,000, and I don't know how you can run a business that way. In fact, I'm certain you can't run a business that way. But I have seen sets of books where the CPA or enrolled agent had guided the client to do everything on a cash basis. And I cringe when I go to run reports in somebody's QuickBooks file and I see that the default has been set to cash basis. I almost wish Intuit wouldn't even allow you that option. It should always be accrual by default. My opinion, of course. Welcome to disagree. Anyway, so we've got that transaction. So we've just established we're going to, when I save it in QuickBooks, we're going to increase accounts receivable. That's on the balance sheet. And we're going to increase an income account. That's on the P&L, right? So back over to here. And the other thing to keep in mind is when I'm posting an invoice transaction, the debit for whatever its total is always going to accounts receivable, right? The credit of the journal entry is going to whatever account this product is linked to, right? And so one way to kind of audit that so you can sort of predict what's going on before you save it is go into your products and services list and see, all right, so I'm using this generic services items. I just realized I had categorized these in my sample company and called it annoying items because these are those default items that come in with every new company. Did I filter the category? No, that's really funny. I forgot that I did that. And you can't get rid of them because they're like default items for things. And so you try to make them inactive and they won't go away. So I usually do What?
That's why they're annoying.
Yep. So I usually categorize them because then I can filter out, that category when I'm looking at the list and get them out of my way. That's the way to get them out of my way. That's because then I don't have any others in here right now. But what I would do is I would just choose everything except the, well, in this case, I guess I do have rental unit items, but I think I made them inactive. So anyway, that's funny. So we're using the services one. I guess that should have shown up on, it does, annoying item services. That's hilarious. I really amuse myself very well sometimes. And in this case, it's going to an income account called management fees, right? Whatever. Again, I don't really care specifically about the account setup here. It's just a question of understanding the flow. But I do want everybody to understand that when I'm posting this invoice now, this product is linked to this income account, which means this is the account that's getting the credit in the journal entry from posting the invoice, right? As we illustrated here. So this is really the management fees income in this case. Let's close out of here and let's save the invoice. And that should take me back to the P&L on this tab. Sure enough, my management fees, exactly as predicted, $100,000. Back to the balance sheet, $100,000 in accounts receivable, right? Over here, we were in the statement of cash flows. Let's go back there. Okay, and now I have income of $100,000, but I haven't received any cash yet. So we're going to subtract that out based on the increase in accounts receivable, right? So 100 minus 100 is 0, plus the 500 gets me back to the exact same amount of cash that I have on the books, which is 500,000, right? This is why I love, and believe it or not, I know some of you are going to get scared when I say this, I do like to review this stuff with the business owners. They're not dumb. They'll get it. You just have to explain it to them in sort of non-accounting terms, and then they'll get it, right? And you explain to them, because that's the classic question we're often trying to answer for our clients, right? Is I made $100,000, but I don't have that in the bank. Where is that, right? I put 500,000 in. If I made 100,000, how come I don't have 600,000, right? And now I got to pay 30,000 in taxes out of my own money. And it's like, well, yeah, because you haven't collected that 100,000 yet. And it's easy to see when you demonstrate it in a file like this, where there's not a lot of data sort of bearing the details. You can see the impact of a single transaction very clearly when you demonstrate it like this, which is exactly why I like to do it this way. All right, let's check in on the Facebook feed. Larry, cruel, the tax man said, can sometimes be cruel. Diane says, hey, Seth, any repercussions to changing a file from cash to accrual on the file? You're talking about the default setting. I have always changed it from cash to accrual when I've seen it, the default set to cash, and I have not had any problems, except if I forget to rerun the reports on a cash basis when sending them to the CPA, and then usually I get an email asking me to send them in cash basis format. So, and oftentimes what I actually like to do to sort of cover all bases, and also it answers some questions that are inevitably going to get asked, is I just send 2 sets of financials, cash and accrual, and that seems to cover me, right? And oftentimes that can help me in answering their questions, because as we all well know, oftentimes even on a cash basis, QuickBooks will show amounts in accounts receivable or accounts payable. And usually in desktop, I remember I was able to prove this clearly. I haven't tried to with QuickBooks Online. I'm guessing the same issue is going to come up, is if I, for example, have an item in my item list that is mapped to a balance sheet account where the income account might normally go, such as if I have an item that I'm using to collect a deposit from a customer that goes to a liability, that often in desktop it was definite. QuickBooks Online, I haven't actually tested this yet, but again, I'm assuming it'll be the case that it can't eliminate that on a cash basis, because it's looking to eliminate income against accounts receivable. Or, and in this case, it would be a liability account. So when you have things going from one place in the balance sheet to another place, like invoicing something that's going to accounts receivable and a liability account, QuickBooks has trouble trying to sort of reconcile that from accrual to cash. So you still may have some explaining to do when you do that. But setting the default to a cash basis won't solve that problem anyway. Okay, so now if at this stage we've got the invoice, we've earned the money presumably, right? Or we've invoiced them for it. We're planning on providing whatever service it is. Let's say the client now says, hey, you know what? I've changed my mind. I don't want you to do the services. I'm not going to pay you for them, right? There's no refund to be issued, right? And that's where an important distinction comes in between whether I'm going to do a customer side, a credit memo, or a refund receipt, right? A refund receipt is specifically for the case when I'm actually going to be issuing a refund, right? So this is the important distinction. This affects cash flow. Alternatively, I might do a credit memo. That does not affect cash flow, right? That will simply be something I can use to offset the receivable, right? And then I'm done, right? So I can issue a credit memo. When I issue the credit memo, I'm going to want to use the same product or service that was used on the invoice, right? That's one way. The other way, and sometimes I do this because I want to be able to track separately what we've done in terms of refunds or allowances. So sometimes I'll create a generic product or service called sales returns and allowances and map that to an income account on the P&L also called sales returns and allowances. That way I can see here's all the income we've earned minus all the returns and allowances we've offered, right? So that's another way to do it. If I use the product that was originally used on the invoice here, it's simply going to zero out that income, which is fine, but I sometimes like having that detail on the P&L. I especially like to be able to see it because sometimes it comes in handy to be able to report back to the client and say, hey, client, it looks like we're giving an awful lot of returns and allowances. This could suggest defective products, or if it's a service-based business, it could suggest that for some reason people aren't happy with the services, or maybe it's an indication that we're not presenting the service as well, that people are getting into it and figuring out that it's not what they expected and then asking for a refund. So it could be important data that could help us analyze potential problems in the business if we treat it separately. So that's how I often prefer to do it, and that's the reason why, right? So I'll just create sales returns, and allowances. Okay, and we're going to set that up. I'll just set it up as a service item, and the income account is going to be the same thing. Sales returns and allowances. Let's create that. The type is going to be income. It's really what we call a contra income account, right? Contra meaning it goes against. And we have a detail type that's perfect for this. Discounts or refunds given. I'll keep the name, save and close. And now I've got my item that I need. And I'll put it in for the whole 100,000. Okay, now let's go back to the T accounts and figure out what this looks like here. So in transaction 3, right, $100,000, and this is going to be customer cancels, right? They haven't paid, they're not requesting a refund, they've just canceled, they don't want to do it, okay? Now, of course, the other sort of quick and dirty way would have been to just void the invoice And you can do that. Nothing wrong with that. That'll just reverse out the income. The entry here for this is going to be that we're going to eliminate the receivables and we're going to eliminate the income. So it's just going to, oh, no, I'm sorry, we're not going to eliminate the income. We're going to have a new income account called sales returns and allowances, which is going to get, it's going to effectively wash out this income, but it's going to be in a different account. And that's my whole point, is when we look at this on the P&L, we're going to see two separate line items. One showing that we at some point earned $100,000 or thought we did. And then another one, and then in the sales returns and allowances account, it's going to be negative $100,000 to show that it was refunded effectively, not really refunded, but, again, it was credited. So in transaction number 3, we're going to credit accounts receivable, right? And then I think I'm out of accounts here to the right. So let's go over here and I'm just going to change this one and we're going to call this sales returns and allowances. And as always, you're welcome to this template if you want to review it afterwards. And of course, once this is posted in NerdBuzz in the Zoom in section, I will link to it so that you can make a copy of it and play with it. So this is transaction 3, sales returns and allowances, 100,000. Okay, and I have configured this to pick up the titles of the accounts from the actual T accounts below. So notice this is now updated, and now we can see our entry. It literally reverses this original entry, right? This and this, by zeroing out the accounts receivable here. And again, we're just debiting a different income account, so that when I save this, we'll look at the P&L and you'll see the impact. So customer canceled. Too many L's. Who's the customer? Always right. And save and close. Accounts receivable now zeroes out. And here's what I was talking about on the P&L. So we show the management fee income, but then we show that there's sales returns and allowances. So net effect is $0 on the top line. Okay, and statement of cash flows, of course, shows nothing because all the action happened in and out on the balance sheet. So there was, well, actually, no, I take that back. We lost the net income of $100,000 because we reversed that income. So we're kind of back to where we started, where we just have the $500,000 contribution that was made to open the bank account. Okay, so that's one scenario. We use the credit memo when we either haven't been paid yet and we're just giving them a credit, or if they've paid, but they don't want a refund, they just want a credit towards a future purchase, that's when the other scenario when we use a credit memo. Okay, so now I'm gonna wipe out that credit memo and we're gonna back this up and we're gonna post a payment and look at, because really what we've seen now is what happens when they haven't paid. We just invoiced them and they canceled, and this is the whole story, right? I'm gonna back up, remove that last credit memo, and we're going to receive a payment, and then we're going to talk about the two scenarios. If they want a credit towards a future purchase, then again, we use a credit memo. If they want a refund, then we use a refund receipt. Plain and simple, sort of. All right, so let's go to recent transactions, and I'm going to delete this credit memo. Okay, that gets my statement of cash flows back. Okay, we'll get rid of transaction 3 here. Actually, we'll just change it to customer pays. Right, and then we'll make the appropriate changes here in transaction 3. So accounts receivable still gets zeroed out. Difference here is instead of debiting sales returns and allowances, we're actually going to debit the bank account. Okay, so now the bank account shows 600,000. Accounts receivable still gets zeroed out. All right, so we'll use this screen here. We'll go receive payment. And the only thing I'm sort of ignoring here in the T accounts is if it went to undeposited funds first, right? But undeposited funds is simply a clearing account that the payment clears through if we don't go directly to the bank account with it. That's all that is. All right, so we're getting a payment from Always Right. Full payment on this invoice. We're going to deposit directly to the bank account as I did in the T accounts, and we'll say that this happened on January 31st, 2 weeks after the invoice, right? So now when I save this, again, we're going to see cash go up to $600,000. We're going to see accounts receivable gets zeroed out, and of course, we're still going to have $100,000 in income on the income statement, but now in the statement of cash flows, we'll see that we're no longer reversing out that $100,000 of net income based on an increase in accounts receivable, because now the net increase in accounts receivable is zero because that entire $100,000 of net income has been realized. It's been received. So let's save this. Okay, so sure enough, Continental Bank now has $600,000. You can see in the equity section, I have the initial contribution of $500 and the net income of $100,000 closing out to the equity section. Nothing actually changed on the P&L. We still just have the management fees, $100,000, and no expenses, so it's purely $100,000 in net income. And now on the statement of cash flows, like I said, no longer an increase in accounts receivable to reverse out this net income. We've received the whole thing. So we have the net income of $100,000. All of it's been paid, so it's been provided. So it's the entire $100,000 is in the net cash provided by operating activities. Adding that to the initial contribution of $500,000, we get cash at the end of the period of $600,000, right? So now if the customer says, hey, I want a credit, you know, I'm not happy, and we agree, let's say, to give them a $25,000 credit towards a future purpose, then again, we're going to do a credit memo, right? And let's write this up here in the T account. So $25,000 customer credit not satisfied, right? Whatever it is. They don't want a full refund, but they're not happy. They want a $25,000 credit towards their next purchase. So again, no impact on cash flow, right? So here's my credit memo. We'll still use my returns and allowances because it still is just that. Okay, and what this is going to do, of course, is $25,000 in transaction 4. It's going to go here. We're going to have negative accounts receivable, effectively, right? Because we owe them money or services. And then the sales returns and allowances is going to get the debit. Okay, everything balances. Should all work. Let's post it and find out. So when I hit save and close, we're going to see negative accounts receivable for $25,000, and we're going to see the contra income on the P&L of $25,000. Nothing should happen on the statement of cash flows because, again, there's zero cash flow impact on this transaction, right? And that's kind of the key that I want to drive home here, is really understanding where there is and isn't a cash flow impact, right? So now we've reduced the net income by $25,000, right? Did I do something wrong? That should, oh, that's in the I'm in the statement of cash flows. That's fine. So we've reduced the net income by $25,000, which is now sitting as a decrease to accounts receivable, right? Because remember, it's negative accounts receivable, which for statement of cash flow purposes gets added back to net income to arrive at cash, right? Because we've reduced net income by a non-cash item. We didn't give them any cash back. We just gave them a credit. So we're still at $100,000 net cash provided by operating activities because we've still collected that whole $100,000. That didn't change, right? Added to the contributions of $500,000, we're still at $600,000 here. I'll come back to this because after we look at it on the balance sheet and the P&L, it'll probably make more sense, right? But here, sure enough, we still have $600,000 in the bank, right? The net cash flow for this year so far was a $500,000 contribution plus the $100,000 that we got paid by the customer, right? Then we said, okay, we're going to give you a credit towards a future purchase, which gives us a negative AR, right? And if I want to duplicate this, because obviously if I see negative AR on a balance sheet, I immediately want to know what's going on there. Of course, in a real situation, that might be buried inside of other receivables, so it may not always be clear, which is why I always like to run my AR reports to see what's really going on in accounts receivable. So let's just look at an open invoices report. That's the easiest one. And sure enough, we can see, okay, Always Right has a credit memo of $25,000. We do actually owe them this money or the services, right? So going back to the balance sheet, this is correct. P&L shows management fees of $100,000 that we originally invoiced, less the $25,000 in returns and allowances. So the net total income is $75,000, right? And now, having seen it this way, going back to the statement of cash flows, it should make a little more sense, right? $75,000 net income plus the decrease to accounts receivable, right? Remember, this $25,000 positive on the statement of cash flows represents a decrease to accounts receivable. A decrease to an asset has to get added back to net income to arrive at cash. All right, now, if the customer now changes their mind and says, you know what, I don't want the credit, I want a refund, then we do a refund receipt. Right, so let's see what that looks like. Of course, the question becomes, what do we use for the product or service on this one, right? We already showed the returns and allowance in the form of the $25,000. But let's do it there anyway. And we'll see how this shakes out. Okay, so before I save it, customer, I can't type, requests a refund instead of the credit. Of course, one way is to go back, remove the credit memo, and then just do the refund, right? Because what this is going to do is you're going to see is, of course, it's going to make our sales returns and allowances $50,000, which is going to be a bit skewed, but it's also going to show, it's going to even out the AR. So we'll see. Let's do the debits and credits on this one. We have a refund receipt, which means it's coming out of cash this time, right? And notice, of course, we have to choose the bank account that the refund is coming from. So that's another indicator that this is definitely impacting the bank account, right? So let's go back here. This is transaction 5. 25,000, that's the credit. And here, we're debiting this by another 25,000. All right, let's save and close. All right, okay. Back to the balance sheet. All right, so this is a little interesting. I may be about to learn something here because my AR is still negative $25,000, right? So let's audit this. Let's figure out what happened. I'm going to go back to my refund receipt. Okay, so what it's telling me is that it's not really affecting AR. What it's doing is it's affecting, because it's really crediting the bank account, right? Or it's, it's crediting the bank account, and it's debiting this. So the sales returns and allowances on the P&L is $50,000, exactly as I predicted, right? The problem is it's leaving the balance in AR, right? And this is kind of what I wanted to illustrate that's different in QuickBooks Online, the distinction between the refund receipt and the credit memo, right? So this is really what I wanted to bring this to really underscore this, right? Because the thought would be that the refund receipt would zero out the AR, but it doesn't. It simply reduces the bank account, right? Because we're giving $25,000 back. And then it doesn't affect accounts receivable. Of course, it affects whatever account I link to in the product or service that I used in the refund receipt, which was sales returns and allowances. So what happens is, and this is how we get things back into balance, I really have $25,000 that needs to come out of here and offset the accounts receivable, right? That's what really has to happen here. Or I can simply go in, and since what they asked for was a refund, what I probably want to do, the thing that really makes the most sense, which I mentioned a few minutes ago, is just void the credit memo. By avoiding the credit memo, I am effectively reversing that. And now what that will do is it will, my AR will be zero out on the balance sheet, right? Because I reversed the credit memo. Still reduced cash by $25,000 because I still gave them the refund, right? And now if I go back to my profit and loss, right, I have the $100,000 that I earned less the $25,000 that should be there in sales returns and allowances because that's the amount I refunded, right? And this is coming from the refund receipt now. If I drill in, this one's voided. The $25,000 that's still sitting in here is coming from the refund receipt. Okay. I could have, like I said, done a journal entry or something to basically move the money out of sales returns and allowances and apply it to accounts receivable, and it would have accomplished the same thing. And Courtney is watching in the live Facebook feed, and she says it makes sense because you would do one or the other, not both, and that's absolutely correct. What I wanted to address was the possibility that the thinking was that the refund receipt would somehow offset the credit memo, and I wanted to highlight the fact that it doesn't. So that's exactly the point, and Courtney's right on with that. You do one or the other, not both. And the difference between voiding the credit memo, which is, again, exactly as Courtney points out, I think that's the right way to do it in the bookkeeping. Both would get you the same result. To me, this is bulletproof, right? To me, this tells me the right story when I get into the details of what happened, right? Initially, I issued them a credit memo, and then they said, you know what? We'd rather get a refund. So just send us a check for $25,000. Okay, well, then I'm going to avoid the credit memo because we're not going to do the credit memo. Instead, we're going to do a refund, right? And now when I'm looking at this, I can see, and this is why we void and don't delete on something like this especially, is because the audit trail is there. It shows that I have a credit memo that was voided, and then I have a refund to the same customer. Again, somebody who knows nothing about these transactions can look at these details and put the pieces together and figure out the story without even having to ask the customer, right? To me, this is like one of the key differences between what I call compliance bookkeeping versus bulletproof, right? Compliance bookkeeping, it gets the job done, the balance sheet's right, the P&L is accurate, all that. But with bulletproof bookkeeping, the difference to me is the details inside tell the right story, right? It goes beyond just good documentation, being able to prove that you spent money on something legitimate. It's this stuff too, right? And that's the key. And of course, if in fact they simply requested a refund in the first place, then we would just do the refund receipt for whatever amount was being sent back to them. And in that refund receipt, remember that the product or service that we're using, which in my case is the sales returns and allowances, is going to drive the debit of that transaction, right? The credit is whatever bank account I put here in the refund from account. So this is in the journal entry, this is always what's being credited, this is what's being debited. And another fun thing I love to do, and I do show this to clients even though they know nothing of debits and credits, they still get the concept, is to look at the journal behind the transaction. That's another way to confirm our understanding of what this is impacting and where. If I click to show the transaction journal, I can see very clearly I have my bank account, Continental Bank, being credited for $25,000, and my contra income account called Sales Returns and Allowances being debited for $25,000. But a lot of times this saves me when a customer is questioning, where it comes up most often is when a customer of mine is questioning whether or not their cost of goods sold is being calculated accurately. I'll go to the invoice and produce the journal entry of the invoice, and that's where you can see item by item what the cost of goods sold is that's being used. Always remember, if you're in QuickBooks Online like we are, that you have to explain to the customer that the calculation of cost of goods sold is based on first in, first out and not average cost, which means it may not be exactly what they expect to see, but it should be in the ballpark unless the prices of their inventory have changed drastically during the time period, which is not common. So in most cases, it's in the ballpark of what they expect to see. But running this journal entry report on the transaction often, saves me from the trouble of trying to convince the client that it's being done correctly, right? I can show it to them, right? And this is how I prove it. They don't have to understand journal entries. I can walk them through and explain that. This is the thing that's going to confuse them most of all, because they're used to seeing it from their side. When the bank gives them money, the bank calls it a credit, right? So I have to explain a bit of debits and credits to them sometimes where it's impacting the banking because it's the opposite of what they're normally used to thinking. But that's usually not a difficult conversation. I explain it to them very matter-of-factly that, it works differently in accounting, and rest assured, and if need be, I can prove it to them by posting something very obvious like a check, or just drilling into a check and showing them that the journal entry behind a check that they've written is going to show the same thing, that there's a credit to the bank account for the amount. And then I've convinced them. So even the most skeptical of clients can be convinced and taught to look at this, at least with me, to understand and confirm that the bookkeeping is right and that it's accurate and that it's bulletproof at the end of the day. So I love the fact that you can produce a journal entry from any transaction in QuickBooks or QuickBooks Online. Desktop had the same thing, and I've used it a lot. I think a lot of us are afraid to go over that with a client because we're afraid that it's going to confuse them. The key is you explaining it to them. And if the client is that motivated that you're even at that point in a conversation with them, then it's probably safe to say they're willing and capable of learning, at least at a basic level, what they need to understand. And they don't need to understand it too deeply. They just need to understand enough to feel satisfied that what you've done, the bookkeeping, is right and it's accurate, right? So, like I said, I'm going to put this T account template up in the post once it's live on the web. You'll get a read-only version. Just click File, and you can make a copy. It'll put it in your own Google Drive account, because you might have noticed this is Google Sheets, not Excel. If you absolutely insist on having it in Excel, then just download it in Microsoft Excel format. I love Google Sheets. I love how easy it makes it to collaborate on stuff. But I think you'll find, if you don't already do something like this, especially when you get into some kind of a really tricky transaction where it's just not clear. I understand what happened in terms of the operations of the business, but now I'm trying to figure out how to translate that into the bookkeeping. It often really helps to think of it in terms of the debits and credits, because ultimately I can usually figure out where I needed to go on the balance sheet and the P&L, so it's just a question of how to sort of manipulate the forms in QuickBooks Online to get things where I want them, right? And it might be something like, linking an item like a sales returns and allowances to an income account, like sales returns and allowances as contra income to produce a negative income item. It might be a question of thinking things through that way. And that's why I really like to learn to think about these forms in terms of any kind of a transaction that we could create, and being able to think through it in my head, okay, what's being debited, what's being credited, right? So like I said earlier, the invoice, we're debiting accounts receivable for whatever its grand total is. That is what's hitting accounts receivable. Absolutely, no question. Can't even change that if you wanted to, right? There's no drop down in which I can change that. Product or service is what's getting the credit, whatever account that product or service is linked to in the income account field, right? Because remember, we can have the two-sided items, but because we're using an invoice, that means the product or service is going to drive whatever its corresponding amount is through whichever account is in that income field. And if I just confused anybody with that, I'll show you what I mean. So if I go back to the products or services list, and I go into my sales returns and allowances, if I say that I also purchased this product, that has no impact on anything I'm doing on an invoice ever. It's this account that matters when I'm using this product or service in an invoice. And that's kind of the way I've learned to understand this, and it also really helps to think this through that way, is when I'm using both purchase and sale versions of the item, this is the account that's going to get used on any income type of transaction. So an invoice or a sales receipt. This is the account that's getting used. If I purchase it, the expense account is what's getting used when I use it in a bill or a credit card charge or a check or a generic expense. Any expense kind of transaction, this is the account that's going to get used if I use this item in that transaction. So that's important to understand too. So bottom line, on an invoice, debit's going to accounts receivable. Credits are going to whatever accounts are associated with the items that we're using on that invoice. And if you sort of train yourself to think about it that way, it starts to get easier and easier to think through how to get sort of tricky transactions posted, right? And that's my story, and I'm sticking to it on how cash flows when it comes to credit memos and refunds receipts. Oh my. Exciting stuff, right? Anybody, any questions? It looks like I scared some people away while we were working over here. Now that I turned off my screen share and I see our participants list has dropped down. I did that in 97 and up this week too. We were doing cash flow projections part 2. And I scared people away. We started out with more than we finished with. I'm going to go with...
People really don't understand cash flow. It's really kind of simple. Money comes in and money goes out. I mean...
Right. But it's understanding the cash flow through the accounting that gets tricky, right?
I think you're right. It goes through the profit and loss and the balance sheet, and people get confused by that.
So what I would suggest is reviewing this webinar a few times until it's clear, right? You'll get to hang out with me for a couple of hours over and over and over again. That sounds like a nightmare to me. Alexa says, still here. Good explanation. Thank you, Alexa. We have more people live than we do in the panel. Gina, are you skewing those numbers? Are you on the live feed too today?
I am. I
okay,
am.
so one of them is actually a duplicate. Anyway, that's my story, and I'm sticking to it. So, excuse me. So yeah, check back. Usually, I'm pretty good about getting these up next day. Courtney says she's a dupe too. She's in both places. All right, so we have 2 dupes. Perfect.
Seth?
Yes, sir.
I think you could make the argument that the statement of cash flows is probably the most important statement if you want to determine how viable your business is in terms of being able to meet its obligations.
Absolutely.
No question. The way I've explained it in the past is that the statement of cash flows removes all the BS, right? I can manipulate the balance sheet and the P&L to make the company look good if that's all we're looking at. But the statement of cash flows has a way of eliminating all that because it eliminates all the things that don't impact cash.
Because the amount of money coming in is the amount of money coming in, period, end of story.
Right. Although I'll share something with you where even that can be confused. If you remember when Mike Milan and I were doing our cash flow series way back, I think it was like end of last year and into early this year. He shared a story about Sears. We all know the company Sears, right? And many years ago, Sears owned a lot of real estate. They owned a lot of the properties that their stores were in. And what happened was they started selling off a lot of that real estate. So that made their cash flow look really good because they were getting a lot of money in the proceeds from the sales of the real estate, which is not their normal business. So, but where the key is, and this goes back to support Dennis's comment, is you could see those cash flows were not coming from operations. They were coming from investing activities.
I think
right?
you can make the argument that if you are not cash flowing from operations, you really don't have a business.
Right, or it's at the startup stages where it's very common not to have cash flows, especially these days with internet-based startups where their whole survival is based on venture capital. And that's where we get into financial modeling, where they really take a detailed look at their burn rate to see how quickly they're going to run out of money. Years ago, I had a very interesting project I worked on for a bit. It's with a company that's still out there today, so I won't mention who they are. But in their beginning stages, before they even went live, they had a lot of writers that they were hiring to create content for this concept that they had. And I wrote a financial model in Excel for them that gave them the ability to look at 3 scenarios, and we called them conservative, moderate, and aggressive. And I set it up a link to a radio button where it would run a scenario, which is a function in Excel called scenarios. And basically clicking the radio button for each of those different levels would sort of rerun the model with different numbers in place that basically translated to different assumptions about how many writers we hired and paid. Obviously, aggressive meant we had more writers, which means we were paying more money more quickly, which means a faster burn rate. We'd run out of money sooner. But what we really wanted to be able to analyze was, would doing it more aggressively be sufficient to get the work done in time for launch? Or would we just run out of steam before we got everything done and burn people out? These are, so this is where you get, these are like real life use cases for this kind of stuff, right?
Hey, Seth.
Mm-hmm.
Do you have any courses on ratio analysis and industry standards regarding ratios?
So it's funny you ask. I do have a course that I was just reminded by one of our 97 and Up members this past week that I haven't yet brought it over to the new site from the old. And it's dead in the old site because one of the reasons I built the new site was the old site, not a single video renders anymore. The guys who designed my site completely abandoned me on that one, and I don't know how to fix it. So I am going to get that course moved over. It's actually called Business Valuation and Analytics, and it walks you through a lot of the ratio analysis stuff that you're talking about. And what it doesn't get too deep into, though, is the industry sort of standards.
Mm-hmm.
But I'll say this, that the key to that is you can use NAICS codes, right? You know what NAICS codes are. I can never remember it, and we just went over it this week in 97 and Up because we were talking about this. It's the National something code system. I forget what it stands for. Anyway, Google it. You'll find it. You'll figure it out. But that's one way. I don't love that way because I don't know how good of a comparison you're getting, because depending on where the company is and lots of other demographics, it may or may not be a fair comparison. My favorite way to do the comparative analytics is to compare me today to me yesterday, right? And so that's how I teach to do it, is to just run a comparative. Don't just look at the ratio, look at the ratio over a timeline so that you can see, are we getting better or worse?
Yeah, I like to keep an eye on when a company's getting too heavy in loans compared to what their equities are.
Right. Yep. And one of the things we looked at this week, again in 97 and Up, was, and this is something Mike and I had done in that series, is looking at the working capital requirement.
Mm-hmm.
And you look at the financial gap, which analyzes your AR turnover, your inventory turnover, and your AP turnover to figure out from the day a dollar goes out to purchase inventory, or in the case of a service business to pay payroll, how long does it take for that dollar to come back with a profit attached to it? And based on that, you can actually calculate what amount of money needs to be in the bank at all times.
Yeah.
And then you can break that down further and say, well, now that we have that number, here's how much is in the bank. The difference is what we need to have access to at the very least in the form of, let's say, a line of credit or something.
Right.
Yep. So, yeah, all that content I can actually get loaded up into the new site. And now that you're the second person who's brought it up, I think I'm going to work on that this weekend.
Yay.
So, and of course, that's all included for 97 and Up. I have to figure out how to price it for others, but I'll figure out something fair. All right. Anybody else? Any questions? Okay, cool. Well, I will look forward to any follow-ups for anybody who watches this after the fact. You know where to find me. You can always reach out to me on Facebook, Twitter, LinkedIn, email, post mail, anything. I'm usually pretty good about responding in any way, shape, or form. Even text messages. I have a client now who sends me business documents in the form of a photo and a text message, no matter how many times I've asked him not to do that. So now what I've done is I've told him that I can guarantee him that I will drop any of those balls in terms of anything he sends me in the form of a text message. So I've disavowed any responsibility for following up on anything he sends me in the form of a text. Right? I told him I will, I'm not guaranteeing that I won't follow up. I won't intentionally not follow up, but I'm not guaranteeing that it will get followed up on if he sends it to me in a text message. That's how I have to deal with my clients these days. I have to just lay the law down. And that's it. It's Nerd's Law. All right. Well, Gina, what are we doing today? Usual, open.
Usual, you know, we're open at 5 o'clock. We discuss what we're going to discuss, and then 5:30 we discuss.
All right. That's 5 o'clock Eastern, 2 o'clock Pacific. Just go to SBAA, Small Business Accounting Advisors on Facebook. If you're not already there, Gina will let you in, I'm sure, you know, pending a thorough credit and background check. And then you can
Not really.
yeah, and then you can join in on that conversation. And me, I'm gonna go get myself some breakfast because I haven't eaten anything yet today, and I can feel my blood sugar dropping.
Bye, everyone.
Bye.
Bye.